Hello, and welcome to the Venue Coach Blueprint for Owners. I'm Kyle Labar. This podcast is all about helping you fill your wedding venue with more bookings, earn more from each one, and keep your customers happy for a long time. We'll also talk about some tough times and big lessons that I've learned along the way. Let's dive in together and make your venue the best spot for weddings. Hey everyone, welcome to another episode of the Venue Coach. And in today's episode, I wanted to share our experience with dealing with banks on getting loans for your venue. And so, for many of you, it's not always the case that you have the land already. Some of you, yeah, but many people don't have the land. You may not have, like, if you don't, you don't have the building as well. And so, getting into the game without having any of that, but you have a background, maybe you're a wedding planner or a photographer, and you think, hell, let's do the venue, then we can add the two services together. Great idea. So the thing that you're going to have to keep in mind is that bankers don't have a lot of vision. And so if you're not directly in that space or have direct experience, then they're going to want to see you pick up a place that's already in existence. So that's the first issue that we found. We originally had desires to build, but we were faced with that challenge from lenders because we didn't have the direct experience. And so we had to find a place that was already operating as a venue, and then we could do our market research from there. So the big numbers that they care about, if you're brand new, is a bit different than if you are in the game and you're just looking to refi or possibly get a second venue. And so the numbers that they look for when you're brand new is actually more on the personal side. So yeah, they want to see that the business is already going and what it was doing. So in our case, we were buying a venue that was not performing very well and hadn't been for some time, had been on the market for a while. And so there wasn't a lot to lean on there, so they leaned on us personally. So the first thing is make sure that you have personal income, that you have good credit score, and you might need some personal collateral to put up as well because you're just starting out. So we went the SBA route, and really we were searching for a lot of different lenders. And the trouble with the SBA at our time was the variable interest rate. So it's prime plus whatever it is, 2.25. So right now our interest rate is very high. And so that's the danger. When we got it, it was like 5.5, and now we're at like 10 plus percent. So over the past 2 years, it has gone up almost double our interest rate. So that sucks, but they're also more amenable to brand new businesses. So there's some pros and cons. And so typically on an SBA, there's a 3 year um, 3 year payback penalty, and so you're within your first year, it's 5%, 3% on the second year, and then your final year, the third year, is a 1% um, prepayment penalty. And so those are some benchmarks for you to think about if you're trying to get it into a commercial loan later, which is smart if you're at a high interest rate like we are. And so the commercial lenders won't look at you until you've been in business for at least 2 years. And so you'll be in your third year. One, like for us, we're looking at this now, and we will have a 1% penalty, and but the interest rate that we're going to be saving will pay our 1% or make up our 1% in interest savings within 3 months. And so it's a no-brainer for us to look at conventional now, or conventional commercial loan. And so that's some things to keep in mind. And then the big things when you're doing your forecasting is you want to show that there's a lot of opportunity in the area. And actually, in most areas, there is usually a 55 wedding, 50 to 60, let's just say 60 to 1. So 60 weddings per every one venue is the average in most areas. So you look that up. I use wedding.report, and you have to do a membership to get like pretty much any data. So a couple $100, like $200 or $300, something like that for the year. and then you can start doing your analysis. Only when you start out are you looking at prices of your competitors, and that's just to give you a good idea so you can start doing your projections. So the other thing we found is we typically spend on marketing about $1,500 to $2,000 a month, and with that we're able to get 20 plus tours a month at each venue. And so when you're doing your forecasting, you want to forecast just like what's your break even amount. So that's to pay the loan, that's to pay your overhead, so your utilities, your internet, your maintenance, anything like that. And then what is your cost to fulfill each event? And typically that's about $1,000 depending on how your setup is. So usually you can expect to pay out between $500 to $1,000 per event in your cost. And so that's cleanup, that's setup, that's if you have a bartender, security, things like that. Just depends, and can make that change from there. Then the final consideration, as far as expenses, actually those are the three big ones. Your mortgage, which is a fixed cost, but I separate it because you have to absolutely make sure you pay your mortgage. And then there's the utilities, fixed costs, overhead for just keeping the lights on and all of that. And then the cost to fulfill the event. So cost to acquire, cost to fulfill, cost to exist, and then your mortgage, which is another cost to exist. But and so you figure out your baseline bookings that you need per month for that. And so for us, based on the price in our area, we discovered that we needed to get at least 5 to 6 bookings per month. And what's the likelihood of that, right? And so if it's 60 to 1, well, that's 5 events per month on average. So we said, hey, that's the average, that works. And then we were able to be a bit more convincing when we approached the bank. And so the key numbers that they are looking for is your LTV, so how much money you're putting up versus the value of the property or the business, right? And so typically the sweet spot or the minimum that banks want to live at is 20%, but they would prefer to be at 25, and 30 is going to be like a really sweet zone. So if you're looking at a $2 million property, 30%, you're looking at 600,000 that you're putting in. And so if you have that, then that's going to be, like I said, a sweet spot for them, and you'll get way less pushback from that. And then the other number is your DSR. So that's the debt service ratio. And what that is the ratio, how, like, based on what you're making, how much over that amount are you making to pay the loan back, right? So basically that's your EBITDA number, and then you multiply that by you multiply your monthly mortgage amount by 1.25, which is a good number for them to be at. You don't want to, most banks won't go lower than 1.2. So if you're 1.25 or 1.3, you multiply your mortgage amount by 1.25 or 1.3, and that amount that you get is the amount that you need to be making on your EBITDA to then service the loan. So they're going to want those numbers as well. The last consideration for brand new venue owners is that you're not going to be cash flowing for probably 9 to 12 months. Like realistically, it's going to take a year to start cash flowing. The nature of the business is you get a deposit that's typically non-refundable, and then you have payments, but the average from booking to fulfilled event is 11 months and change. So you're not going to receive the full payment for several months. And I've seen some venue owners that they get the 50% deposit and then 45 days the rest is due. And so that speeds things up as far as cash goes. And so if you're doing something like that, which it may work for your market, it may not. But if you're doing something like that, then, you're able to speed up your time to cash flow by quite a bit by a couple of months, but it's still going to take some time to build up the cash flow. So keep that in mind. If you're brand new and you talk with the bank, you say, "Hey, we're going to need working capital while we build this up." Especially if you're not inheriting a bunch of events from the seller. And so we were in a situation where we took over, I think it was 4 or 6 events. And so it was basically nothing. We got a check for $20,000 from the seller for the deposits. And then 2 of them we had to refund because when we came in, we made some aesthetic changes and the 2 brides weren't happy about that. So we had to refund it. And so we made the right decision for the long run to make those aesthetic changes, but in the short term we had to be good and just pay those people back, and let them know that we were making the changes and give them their money back so there is no harm, no foul, at least on our end. And so that was the situation that we faced, and we got working capital built into our loan, as well as some FF&E allowance to make those upgrades and aesthetic changes and things like that. So those are some things to think about if you go to a property and you see that there's potential to make it better, and you just need to put a little bit of dollars in to do that. Then you can talk with the bank to work those types of things in. So then what they want a personal financial statements, they want your 2 years of tax returns for yourself as well as any businesses that you own outright, and they want that for all parties involved. And so anybody who's going to be a guarantor, any owners who have 20% or more, that's who they're looking at. And so the personal financial statement, that's your assets versus liabilities and what your net worth is as well as income. They're going to do a hard credit check to make sure that you're not on poor credit, or they're going to look into if you have bankruptcies, things like that. So typical bank stuff, but you want to have all these documents prepared, and then on the back end, don't be surprised when their underwriting team starts, "Hey, what is this?" They got to call you several times just to get clarification. They might ask you for the same documents a few times over, and then once you get that, the big thing that you're looking for is a letter of intent, and that shows that they've done the due diligence. That's not saying that they are committed to doing the deal, but rather they are very, very interested and they want to press forward. It's a good sign generally. It means that you're probably going to close on the deal and they're going to work through it and get it done. But it doesn't mean that they have to. It just means that based on all the information you've given them, they're very interested in doing it. And that's where they lay out the terms and the percents and all of that. And so the other consideration, if you're brand new, you can work into where you can pay interest only for 6 months or a year while you're building up that cash flow. And so you can negotiate all of that, but these are things that you should know going into it. And so that's the rundown, the long and short of working with the banks. Don't be afraid also to get all the information to the banks, and not just one, but reach out to a couple. And then one of them's going to do, or they might all do, a appraisal, but you should really, once you get to the appraisal, they're going to want you to pay for it, and so you should usually only get one and ask them to share it with the other banks, and make sure that that's going to work for the other banks so they're not all being uppity about it. So things to keep in mind. And then the last one would be the timeline. If you're doing the SBA route, it's probably going to take 4 months. That's what you should plan on. From the time you start working with them and start getting them documents to the time you actually close, plan on 4 months. And if you keep that in your mind, if it happens sooner than that, then it's going to be gravy, but that should be your goal when you do it. And so when you do the contract with the seller, get it as close to 4 months as you can to keep everybody happy, because otherwise you got to go through the hassle of doing extensions and all this. And so you build in your due diligence. You have an option period, and which is saying that for whatever reason you can back out, and usually you pay like $1,000 or $2,000, something like that. And so build those things in, but just expect that the time it's going to take on from start to finish is going to be about 4 months. So I hope this was helpful for you, especially if you're starting out. If you've never dealt with the SBA, you've never dealt with getting a loan, and you're not in the game, that's really who this is for. But the general guidelines, principles, the things that the banks are looking at, that doesn't change whether you're new or getting into another one. But I hope this was helpful. If you found it so, please share, please review, and drop a comment, and I will catch you guys in the next one.